Hello and welcome back. In our last video, we covered the basics of options, calls, and puts, and I gave you a pretty serious warning. Buying options is a high-risk game where most beginners get wiped out. But what if I told you there's a way to use options where the odds are actually in your favor? A strategy where you get to be the casino, not the gambler. This strategy is called the covered call. It's often described as the most conservative, beginner-friendly options strategy out there. Some even call it the only one a beginner should ever consider. But is that true? Is it really that safe and simple? In this video, we're going to find out. We'll break down exactly how covered calls work, walk through a real-world example, and give you the unvarnished truth about the risks and rewards. By the end, you'll know if this is a smart tool for your investing toolkit or just another trap. Let's get started. So, what exactly is a covered call? The best way to think about it is that you are becoming an insurance company. Remember, a call option gives the beer the right to purchase a stock from you at a set price. When you sell or write a call option, you're taking on an obligation. You're promising to sell your shares if the beer decides to exercise their right. A covered call simply means you sell a call option against stock that you already own. That covered part is crucial. You're not selling a promise you can't keep. You have the actual shares in your account to back it up. Imagine you own a house that's your stock. An insurance company collects premiums from homeowners every month. Most of the time, nothing bad happens, and the insurance company just keeps that money. But if there's a disaster, like a fire, they have to pay out. When you sell a covered call, you are that insurance company. You collect the premium, which is the price of the option, right up front. This is your immediate, guaranteed income. And you take on the risk that you might have to sell your house, your shares at a predetermined price, which is the strike price. This happens even if the market value of your shares is much higher. That's your disaster. So your goal here isn't to get rich from some stock that goes to the moon. Your goal is to generate consistent, modest income from stocks you already own, while accepting a hard limit on your potential upside. Let's make this concrete with a step-by-step walkthrough. Imagine you own 100 shares of Apple. You bought them at $150 per share, and the stock is now trading at $170. You're happy with your gain, but you wouldn't mind making a little extra income. You also think Apple probably isn't going to move much over the next month. Here's how you'd set up the covered call. First, you sell one call option contract, because one contract controls 100 shares. You need to choose two things: a strike price and an expiration date. The strike price is the price at which you agree to sell your shares. Let's pick $180. You're basically saying, I am perfectly willing to sell my Apple shares at $180. For the expiration date, let's pick 1 month from now. Next, you collect the premium. The beer pays you for this contract. Let's say the $180 call option, expiring in 1 month, is worth $3 per share. Since one contract covers 100 shares, you instantly receive $300 into your brokerage account. This money is yours to keep, no matter what happens next. Now, by the expiration day, one of three things can happen. Scenario 1. The win. Apple's stock price stays below $180. The option expires worthless. The beer isn't going to pay $180 for a stock that's trading at, say, $179. So what happens? You keep your 100 shares of Apple, and you keep that $300 premium. Your effective cost basis on your Apple shares is now down to $147 per share, your original $150 purchase price, minus the $3 premium you collected. You can then turn around and sell another covered call for the next month and do it all over again. Scenario 2. The assignment. Apple's stock rises above $180. The option is now in the money. The beer will almost certainly exercise their right to buy your shares from you at $180. Your shares get sold or called away at $180. Let's look at your profit. You made your original gain of $30 per share from $150 to $180, plus you got that $3 premium. That's a total gain of $33 per share, or $3,300 on your investment. Not bad at all. But here's the trade-off, what we call opportunity cost. If Apple skyrocketed to $200, you still only sold at $180. You missed out on that extra $20 of profit per share. This is the deal you make when you sell a covered call. Scenario 3. The crash. Apple stock price drops way below your purchase price. Let us say it falls to $160. The $3 premium you collected acts as a small cushion against that loss. On paper, you're down $10 per share, but that premium softens the blow to a $7 loss per share. But I want to be very clear on this: the covered call does not protect you from significant downside risk. You still own the stock, and you will feel all of its losses, minus that small premium you collected. So, let's get brutally honest. Is this really a strategy for beginners? Let's weigh the real pros and cons. First, the good, and why people love it. Number 1 is income generation. It is a powerful way to generate consistent cash flow from a portfolio that is just sitting there or moving sideways. This is especially appealing for retirees. Second, it lowers your cost basis. That premium you collect directly lowers the effective price you paid for your stock, which increases your overall profit margin if you eventually sell. And third, it forces discipline. It gives you a pre-planned exit point, the strike price, for taking profits. This can stop you from getting greedy and letting a winning trade turn into a loser. Now for the bad and the ugly, what they don't always tell you. First is the capped upside. Watching a stock you own soar past your strike price while you re-locked in at a lower sale price can be incredibly frustrating. It feels like leaving a ton of money on the table. This is a psychological risk that many people really underestimate. Second, your downside risk is still huge. Never forget this. If your stock crashes 30%, that 3% premium you collected is like a tiny band-aid on a massive wound. You are a stock owner first and foremost. Third, tax complications. Getting your shares called away is a taxable event. It can trigger capital gains taxes you weren't planning on for that year. Also, if you sell a covered call on a stock you've held for less than a year, it can reset the clock on qualifying for long-term capital gains rates. You should definitely talk to a tax professional about this. And finally, it's not free money. It's compensation for taking on an obligation. You are trading away your unlimited upside potential for immediate, certain cash. So, should a beginner actually use this strategy? Here's your checklist. You should only use it on stocks you already own and are truly willing to sell at the strike price. Only use it on stocks you have a neutral to slightly bullish outlook on, meaning you don't expect a massive surge. Only use it after you fully understand that your upside is legally limited the moment you sell that call. And only use it with money that's not part of your core, long-term investment plan. If you can check all those boxes, then yes, a covered call can be a prudent, beginner-friendly way to dip your toes into selling options. It's a strategy built on patience and moderation, not excitement and hype. So to quickly recap, a covered call is selling a call option against stock you own to generate income. The best case scenario is the stock stays flat or rises slightly, and you keep both the stock and the premium. The trade-off is that you sell your unlimited upside potential in exchange for immediate cash and a predefined exit price. Covered calls are not a magic bullet for income. They are a tactical tool for specific market conditions and for a specific investor mindset. They work best in sideways or gently rising markets on stocks you wouldn't mind parting with. For a true beginner, the number one job is mastering the psychology of owning stocks through bull and bear markets. But once you have that foundation, learning to use a conservative tool like the covered call can be a logical, empowering next step. Start small. Start on a stock you know well. And always remember, you're the insurance company. Your job is to collect steady premiums, not bet on disasters. Thanks for listening, and don't forget to subscribe for more content.